All right. What is up, traders? What's up, tycoons? Super excited for today's video. Today, we have to talk about the stock market. If you didn't know, we are going to have the busiest week for S&P 500 earnings this week. All right. We've got Apple in there. We'll take a look at a bunch of the big earnings we have coming up. We'll also break down the S&P 500 chart in today's video. It does appear we are due for a bounce. The big question is, will this be a dead cat bounce and continue the downtrend? If we break through 4,100, are we going to potentially come down to this 3,800 area? We're going to take a look at TNX. This is our 10-year treasury yield. TNX has been extremely bullish and it's consolidating now and appears to be ready to break down. Of course, that would result in something like TLT heading to the upside. TLT appears to be trying to put in a wave 5 bottom. We're going to look and wait and see what happens with TLT. So we'll break down those charts. And before we break down those charts, there's a lot of good data that I want to share with you guys, right? We're going to go through this data today, go over, some of the macro data and some of the economic data that's really important that I want to bring to you guys' attention. We'll break down all of that in today's video, go into positioning and different things like that as well. So that way you guys can, stay on top of the market and actually have a good resource for, valuable information. But as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So read through the disclaimer. If you're new to the channel, I started a completely free newsletter, Investment Intelligence, giving out free valuable finance content as well as free trade ideas every single week, highlighting some of the conditions we're looking at on the charts. You can see how that Tesla trade idea worked out. Right, they're not all long ideas. There are short trade ideas too. This was one on Stanley Black and Decker, highlighting the rising wedge, and you can see how that one played out very nicely. After going over the conditions. If you want full access to all of the trade ideas, you can always join the Discord. Okay, the Investment Intelligence Discord using the link in the description. Otherwise, you can sign up for the free newsletter. All right. And I also have my Ko-Fi page here as well. That's where we book the 30-minute and 1-hour sessions. Okay. So if you ever feel like you need that one-on-one interaction, you can book a session with me directly through the Ko-Fi platform, request a YouTube video, and click on this buy a coffee button if you ever want to leave basically a tip or donation for the free valuable content I do put out. And with that being said, we're going to go right into the video. And as I mentioned earlier, this will be the busiest week for S&P 500 earnings releases. Tech will top the list, but healthcare and industrials are very close behind. Now, Apple is actually expected to beat estimates. I do kind of plan on actually playing Apple. Oftentimes, Apple is one of those stocks that's known to have a pre-earnings rally. And oftentimes, option premium will go up, during the week of earnings for certain stocks because of that implied volatility. I'm not sure if I'm going to swing something through Apple earnings, but I am looking to potentially play Apple long and try to capture some of that IV and pre-earnings rally if it does happen. So just, that's just trying to be transparent there. We have some really big ones though. Okay. I'm very excited about Palantir on Thursday. That's going to happen before open. So if you're looking to play that, okay, you're going to need to play before, Thursday open. So you're going to need to get in by Wednesday before close, if not earlier. Okay. There's also SoFi. All right. SoFi. I really love that one a lot, but I didn't get in for earnings. Interested to see how that's going to play out. We have Pfizer, AMD, Caterpillar is going to be really big for industrials. You have Caesars Entertainment. Okay, a lot of these are going to help you out with consumers. Etsy, okay, Etsy was, something that we just put in the newsletter here recently. So go and check out that edition on the newsletter. There's a website associated with the newsletter. You can go back and read all of the articles that have been sent out, kind of like in a blog style. We have Starbucks, Lilly right here. This is going to be another huge one. Shopify, Fubo. Okay. Really, really big earnings week, and it's going to be a lot of blockbuster moves I think we see in the market. So I'm very excited for this. Now, among global fund managers, okay, surveyed by Bank of America, net 54% say monetary policy is too tight and fiscal policy to stimulate. All right. And basically meaning that, the Fed needs to cut rates. Very simply put, okay? That is very simply what this is saying, what this chart is visualizing for you, and what the message that the fund managers in this survey from Bank of America are putting out there, okay? Is that the Fed needs to cut rates, monetary policy is way too tight. Right now, more than half of fund manager surveyed respondents expect the first rate cut to occur in the second half of 2024. The rising share expect the first cut to occur after 2024. Now, this is something that I've kind of been mentioning, basically for the past, you know, 3, 4, 5, 6 months, is that everybody was expecting the Fed to cut rates in early January. And I just mentioned, hey, you don't necessarily want to go all in on something like TLT right now, expecting it to rebound, and expecting the Fed to cut rates in the very beginning of 2024. It's much more likely, and I was on the camp that it's going to be in the second half of 2024. And as they continue this higher for longer policy and mandate, it's very possible it could extend even past 2024. Now, Jerome Powell, we're going to hear from him this week upcoming, and so that will I'm pretty much sure that, in my opinion, he's going to give a hawkish pause. So he's going to pause. He's going to try to come off hawkish and, just keep emphasizing that higher for longer mandate. We just had a strong GDP report come out. We continue to have strong job numbers reports come out, and inflation expectations have ticked up. So all three of those things combined basically tell Jerome Powell that he can keep rates higher for longer and doesn't really need to cut, because the GDP and the jobs reports seem good. Meanwhile, inflation expectations are starting to tick back up again, and his main goal is focusing on keeping inflation down. So for him, they don't really see a need to cut, or basically signal to us that they are about to start cutting sometime soon. Now, U.S. corporate bond markets, just like stocks, they're shrugging off the recent Mideast tensions. Both think the Fed will see fresh geopolitical risk as a sign they should stand pat and adopt a more measured approach to rate policy. Now, this is another thing that people have been saying a lot more recently, basically, is that, due to the geopolitical, factors happening in the Middle East, it's very possible, okay, that this could actually cause the Fed to start cutting rates sooner. Okay, now, when people say this stuff, right, you have to take it with a grain of salt, because oftentimes what they're trying to do is they're trying to fluff up their positions and boost their positions, right? So, at the time when these people say these things, they may have a position that could benefit from that, and then they sell that position very shortly afterwards, and you can hear them saying, in a few months or shortly afterwards, that, oh, well, no, maybe we actually think that, they had it right, and maybe they don't need to adopt a more measured rate to or measured approach to rate policy. So, keep all of those things in mind. This is basically a chart highlighting that. You're looking at U.S. investment grade and high yield corporate bond spreads. This is something that I analyze for you guys every week. I actually have my own chart in the Discord that's available to all the Discord members via a flexible grid, where you guys can come in and check on these corporate spreads and these, basically credit spreads in the market. It's very useful for, kind of seeing, and checking on credit spreads. Now, 56% expect bond yields to be lower, with the highest share of respondents on record. All right. So, you know, basically, again, a lot of people are saying that, due to everything, okay, not just the geopolitical factors happening in the Middle East, that, bond yields are going to go lower over the next 12 months. And I would say that I'm in that camp as well. But, some people are causing for really drastic drops in the bond market when it comes to rates. Okay. Some people are even out here saying that the 10-year treasury is going to go back to 3.5% by the end of the year, or before the end of the year. So that gives us about 2 months really to see a very dramatic drop in the 10-year treasury yield. I don't necessarily know if I agree with that, but I could see things starting to cool off here, and it's very possible we may have hit a shorter term top. But at any moment, at the end of the day, the biggest factor to the bond market and treasury yields continuing to go higher is going to be from a simple fundamental standpoint of supply and demand. We're going to hear from Janet Yellen very soon. And what she says is going to be very impactful to the bond market. I think a little bit more important, honestly, than what Jerome Powell is going to say, because she's basically been flooding the treasury market, the U.S. treasury market. So as she does that, she's massively increasing the supply of U.S. treasuries, which is going to continue to further drive yields higher than because basically there's way more supply than there is demand. Okay. When you look at demand, the three biggest buyers of US bonds are not present in the market. That's going to be the Fed. They're doing quantitative tightening. Okay. For years, they did quantitative easing, buying up US treasuries. They're out. You have China and Japan both out, the second largest holders and buyers of US treasuries. Both of them have been selling US treasuries. Okay. And so you have your three biggest buyers out of the market. And, for that simple fact, I think investors still need to be cautious when it comes to trying to time the bottom in the bond market and time a peak in treasury yields. Now, if we continue to progress, all right, risk sentiment across indicators has deteriorated modestly over the past month. October was a pretty brutal month. It was the worst October the stock market has experienced in the past 5 months. I posted a clip earlier this week. Basically, something that I thought was really interesting is that mutual funds fiscal years, they end in October. So what that means is that, mutual funds are actually doing their tax loss harvesting in October. So if they have a stock that's down massively, they're going to sell those and get those off the books in October. And it's been pretty brutal really since July in the stock market. And so on top of the added short positions that have been coming across the market, you also have these mutual funds just dumping lots and lots of shares of anything that they're down in, really to just get that stuff off the books for their fiscal year ending in October. Now, if we continue moving forward, we see fund manager survey cash levels as a percentage of assets under management up from 4.9% to 5.3% in October, triggering a buy signal for Bank of America Global Fund Manager Survey cash roll. Now, that was kind of a mouthful, okay? But basically what we're saying is, these fund managers are seeing investors shift a large portion into cash, okay? And based on this signal, once it gets basically above this 5% level here, these have all been buying signals sometime in the past, okay? Now, when it's above that level, it's not necessarily just because it's above that level, it's more at a peak, right? So that's, to me, this is a little bit misleading, all right? How they're saying it's triggering a buy signal, but if you take a look, it was triggered in December 2008. But look how much higher it was than where it is now. Okay, October 2016, April 2020, October 2022, the most recent bear market low. It was still much higher and closer to 6% or even higher than 6%. When it comes to the percentage of cash, cash levels with the assets under management. Now, if you look at exposure plans among JP Morgan clients, 44% plan to increase equity exposure and 80% to increase duration near term. Okay, so, you can see that asset exposure, equity exposure in particular, so this would be stocks, this has been on the rise, okay? So in the summer, we were making these new highs and there wasn't really many people looking to increase equity exposure because prices have, had risen so fast and so quickly in such a rapid pace. And since the stock market has been selling off, we've actually seen an increase, in people looking to add stocks and start buying stocks in essentially, AKA buying the dip. Now, this is to increase or decrease bond portfolio duration. Duration means long-term treasuries, right? So things like TLT as an example, okay? And what they're doing is you're actually seeing an increase in this. So there's more people looking to buy things like TLT. There's more people looking to buy things like stocks. And, even though we've experienced a very painful October, it seems a lot of people still want to buy the dip. But long big tech is still considered the most crowded trade, albeit less so than last month. All right, so long big tech right here is the most crowded trade. And then you have short China equities is actually the second most crowded trade. So you've seen a lot of shorts in China. And then number 3 here is actually long Japan equities. And following right behind that is long T-bills, long treasury bills. Okay, so big tech is still the most crowded play. The Magnificent Seven pretty much drive the returns for the S&P 500 index. And if you're long big tech, then, that's if big tech, if you're long big tech and it ends up going up, all right, that's going to ultimately most likely bring the S&P 500 up with it. Now, in October, all right, investors rotated into energy, commodities, Japan, banks, and tech. So we just showed here how Japan was number 3 on this for the most crowded trade. And again, we're seeing here Japan number three, or not necessarily number three, but high up on the list here for where investors are rotating into. You have energy, obviously, due to the geopolitical factors in the Middle East. Energy is kind of a safe haven and a little bit of a hedge against oil prices continuing to rise. We're seeing commodities, telecommunications, so that's that big tech, materials, Japan, banks. And then, you can see what they're rotating out of, and staples, guys. I mean, staples have been absolutely obliterated. If you take a look at the XLP ETF, I mean, it looks very brutal. Utilities as well. I mean, these are pretty much the two worst performing sectors, in the stock market as of recently, and it's been XLU and XLP. We've just seen massive sell-offs in those sectors. Investors rotated out of Eurozone equities into US equities in October at the fastest pace since September of 2022. Okay. Remember, October 2022 is right when the stock market bottomed. Okay. And now it's been a full year. We're back around those levels, and we're seeing Eurozone investors rotating out of Eurozone equities into US equities at the fastest pace since right before we had a bottom last year. Now, investors are bullish on cash, Japan, tech, commodities, and energies. They're bearish on the UK, utilities, the Eurozone, and real estate. Okay. This is where people are overweight. Okay. And underweight. So the blue right here is going to be overweight, and the underweight is going to be over here. And again, you can see utilities. We mentioned utilities just having, being one of the worst sectors in the market. Staples are a little bit higher up on this list right here. Okay, but ultimately, utilities and staples have not been a very safe haven. And it's odd because typically people look at those as defensive sectors, right? And so they should hold up during those defensive sectors. But that's exactly what we have not seen. We've seen massive sell-offs in both of those. Outside of the greatest excess of the dot-com bubble in early 2000s, smaller stocks have never traded at such a deep discount. And so we're looking at the Russell 2000 price to book ratio and the Russell 1000 price to book ratio. Okay. And, you can see the .com is right around over here. And you take a look at the levels that we're at right now. IW. So if you didn't know, okay, long big tech and short small caps, okay, short the IWM has been one of the most successful strategies of the year. Okay. Big tech has performed very, very well. IWM is very near its October lows of last year. And so while those small caps have continued to drop, we've seen a massive rise in the price of big tech. Even with the sell-off that we've had recently, many of those stocks are still trading and having some nice gains on the year. This is SPX daily chart. Now, this may look like a bunch of gibberish. It may seem a little bit too complicated, but we'll make things very simple for you. There's many different wave counts that we have right here, but many of them all have us bottoming right here. The big question is whether it's a short-term bottom. Okay, we're expecting some type of a bounce here soon, up to 4150, 4200, or potentially even 4268 area is going to be some of the price targets to the upside for the S&P 500. The big question is, will that just continue to keep the downtrend going of lower highs, lower highs, lower highs? And let's say we get up to that 4268 area and we put in another lower high and continue heading lower. That's not what you're going to want to see. If you're a bull, you're not going to want to see us, you're going to want to see us get above 4400 on the SPX and start to make some higher highs and start to make some higher lows, and really reverse this trend for a year-end rally. Okay, so whether you want to call this a larger 1, 2, 3 down, and then now we'd be getting a wave 4 up, and then wave 5 would break us through 4100 and take us down to 3800 area. That's a possibility, and that's going to be the really bearish scenario here. Another scenario is that we had 1, 2, 3, 4, 5 down. Okay, and we'd be expecting an ABC move to the upside. Another basically factor in this larger 1, 2, 3, 4, 5 is that we have a much smaller 1, 2, 3, 4, 5 right here as well, also playing out and looking very clean from a structure standpoint. at which point that smaller 5-wave structure is done, and you would also be looking for an ABC there as well. So that's what I mean by there's lots of signs pointing to a potential bounce in the market. The big question is, will it be a dead cat bounce? If you take a look at the S&P 500, it hit oversold and then it hit oversold again. It's very rare that the S&P 500 is trading at these oversold levels historically on the RSI. And so you could say we have a little bit of a bearish divergence where we're oversold here, but we're continuing to make lower lows, and we're back in that oversold territory. And so we could see a little bit of that bullish divergence play out and give us that bounce that we're looking for potentially. Remember, there's lots of factors coming this week, not only earnings, but Jerome Powell. When you take a look at the 10-year treasury, it seems like we finished this wave 5 structure up here, which was wave 5 of 3. And these were the price targets for this wave 3 and for the wave 5 of 3, right? We had 1, 2, 3, 4, 5 up. And now that if we have completed wave 3, it's very possible that the TNX, the 10-year treasury, has some gaps down to fill. And those gaps are going to be right around 4.71. And then we have another gap here just around 4.4. And all of that is going to be healthy territory as well, right? For a pullback to potentially continue going higher. If you take a look at the structure, it's very clean, right? We traded here in between these. And we have very clean structure right now when it comes to the TNX. Okay, we're hitting the top, pulling back, right? Hitting top here, pulling back, hitting top here, pulling back, hitting top. It would make sense for us to pull back right around at least to 4.71. And if we can't, or if we end up breaking below there, then it's very possible that's when we come down to that 4.4 area. But we need to watch out for this being a head fake and for us actually continuing to the uptrend on 10-year treasury yields. Remember the supply factors that I mentioned early in the video. That's something that, even if we do see a shorter term pullback, we need to be cautious of, the fundamentals of the bond market coming back in and continuing to drive yields up higher. When you look at TLT, okay, TLT is very near its bottoming levels, right? So we talked about how TLT could come down to anywhere from 82 to 80 to 78, somewhere around that range. And that's where we would be looking for wave 5 targets to the downside. We came down to that $82 area pre-market, not too long ago. And we've started to rebound since then. So it's very possible that this 5-wave structure could be complete, right? This was 2022 or 2023, essentially right here. We had this very confusing time for a lot of traders. And really all we did was put in an ABCDE wave 4 triangle pattern right here. And as soon as we broke that structure, it's very clean. We broke down, retested, and had the drop down for wave 5. TLT does look very interesting to me right here. But to me, it's still something that I'd rather be patient on and wait for rather than, people who continuously try to time the bottom, right? They said, oh, the bottom was in down here and I missed it. We're up here. I'm going to go all in. Some people went all in here. Some people went all in here. And, cash is a position. I try to remind people of that. You don't have to go all in every single time. You don't always have to feel like you need to be in a trade. You can wait for things to develop, wait for clarity in the markets. There's nothing wrong with that. And, hopefully you guys enjoyed this video. If you did, smash that like button, subscribe to the channel for more, sign up for the newsletter using that link in the description, sign up for the Discord to get access to all of the different trade ideas, and use that Ko-Fi page as well. If you guys ever want to book a one-on-one session, okay, I do those in 30-minute or 1-hour sessions.